Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Lewis, and I'm excited to share today's story with you. We're living in a time of rapid technological change, and one area that's seeing significant innovation is the world of digital payments. Stablecoins, a type of cryptocurrency that's pegged to a stable asset like the US dollar, are becoming increasingly popular. And now, major retailers like Walmart and Amazon are taking notice. According to recent reports, executives at both Walmart and Amazon are exploring the possibility of issuing their own stablecoins. This move could potentially disrupt the traditional payment processing industry, which is dominated by companies like Visa and MasterCard. By using stablecoins, retailers could save millions of dollars in payment processing fees, which could lead to increased profits and lower prices for consumers. But what's driving this trend? The recent passage of the Genius Act, which provides regulatory clarity for stablecoins, has helped to pave the way for mainstream adoption. And with companies like Circle, which issues the popular USD coin stablecoin, seeing significant revenue growth from reserve holdings, it's no wonder that retailers are eager to get in on the action. However, as with any new technology, there are also risks involved. Stablecoins are not insured like traditional bank deposits, which means that consumers could be exposed to losses if a stablecoin issuer mismanages its reserves. And while companies like Visa and MasterCard are adapting to the changing landscape by creating their own stablecoins and infrastructure, there's still a risk that widespread adoption could lead to unintended consequences. As investors, it's essential to approach this trend with a critical eye. While the potential benefits of stablecoins are significant, we need to carefully consider the risks and uncertainties involved. And as always, it's crucial to do your own research and consult with a financial advisor before making any investment decisions. We'll be keeping a close eye on this developing story and exploring its implications for investors in more depth. For now, it's clear that stablecoins are an area to watch, with potential opportunities and risks that could impact the world of finance for years to come. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're halfway through our show today, and I'm excited to dive into our middle segment. As we explore the world of business and finance, we're taking a closer look at a story that's been making waves in the retail industry. Our focus is on Target, the American retail giant that's facing some significant challenges. With the recent announcement that CEO Brian Cornell will be stepping down to be replaced by insider Michael Fidelki, many are wondering what this means for the company's future. To break it down, let's take a look at the numbers. Target stock has been underperforming compared to its competitors, such as Amazon and Walmart. The company is facing pressure on its margins, with cash flows and free cash flow also under strain. Additionally, the balance sheet is below average, which could make it harder for Target to invest in growth initiatives. Now, some analysts are expressing concerns about Fidelki's appointment, given his close ties to Cornell. Veteran trader Stephen Guilfoyle has been particularly vocal, calling Cornell's tenure catastrophic and questioning the decision to promote from within. He's even suggested that the stock could fall further, potentially to around $85.86. On the other hand, some experts believe that Fidelki may be able to bring a fresh perspective to the role despite his connection to Cornell. They point out that he has experience in various aspects of the business and may be well positioned to drive growth and improvement. It's also worth noting that Target is facing external challenges, such as tariff pressures and increasing competition from online retailers. To succeed, Fidelki will need to navigate these headwinds while also finding ways to boost sales and profitability. As we weigh the pros and cons of this situation, it's clear that Target has its work cut out for it. Will Fidelki be able to turn things around, or will the company continue to struggle? Only time will tell. For now, it's a waiting game, as investors and analysts watch to see how Target will respond to these challenges. We'll be keeping a close eye on this story and bringing you updates as more information becomes available. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're wrapping up today's show with a fascinating story that highlights the intersection of technology and workforce dynamics. You might have heard about the recent trend of banks replacing human workers with AI-powered chatbots, but what happens when this transition doesn't quite go as planned? We've got a remarkable case study from Australia, where the Commonwealth Bank of Australia, or CBA, attempted to replace 45 workers with an AI-powered voice bot. The bank claimed that the chatbot was handling higher call volumes, resulting in redundant jobs. However, the Finance Sector Union, or FSU, alleged that this was not entirely accurate. According to the FSU, the bank's claim about the chatbot reducing call volumes by 2,000 a week was, in fact, an outright lie. The union stated that call volumes were actually increasing at the time, and the bank was scrambling to keep up with demand. To make matters worse, it appeared that CBA was hiring workers in India for similar roles, which raised concerns about outsourcing jobs. The dispute ultimately ended up in a Fair Work tribunal, where the bank admitted to not properly considering the increase in calls when assessing the redundancy of the workers' roles. As a result, CBA has apologized and offered the fired workers their old jobs back, or alternative positions within the company. This story serves as a cautionary tale about the potential risks and consequences of rushing into AI initiatives without fully understanding their impact on the workforce. While AI can undoubtedly bring many benefits, such as increased efficiency and productivity, it's essential to approach these transitions with careful consideration and transparency. As we see more banks and financial institutions exploring the use of AI, it's crucial to remember that human workers are not just replaceable cogs in a machine. They have skills, experiences, and contributions that can be difficult to replicate with technology alone. By prioritizing fairness, accountability, and responsible AI adoption, we can work towards creating a more harmonious and sustainable future for both workers and businesses. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, invest with caution.